The stock market has remained at highs despite the Federal Reserve lowering interest rates, which is curious because normally in the past, when the Fed lowers interest rates, the stock market goes down, and we do this cycle all over again. So there's a question that some people have been raising of, could we be on the cusp of another lost decade for the stock market? You're listening to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Signe Lundholt.
And the listener may be wondering, what is a lost decade? In the stock market that many of us have seen, we haven't experienced quite a lost decade in many decades where the stock market is either going down or nowhere, and there aren't really much returns being generated by many companies. And a lost decade means, let's say you bought into a stock at $200 a share. That $200, imagine, stays at $200 for the next 10 years, and it's just not growing for some reason, or it goes down, and then someday it might go back up to 200. But maybe there's already some of a lost decade happening for some stocks that we don't even really think about it of, like, say, since the pandemic, maybe there's some stocks that have gone nowhere or down for the last 5 years. So maybe for some individual stocks, they're already experiencing the machinations of a lost decade. But for the whole stock market, generally, if someone were going to call it a lost decade, it's for the whole S&P 500. So Signe and I are going to reflect on some of what that could mean for what's happening right now or in the future. So what do you think, Signe?
Well, I do think when you look at the data of lost decades, yeah, we potentially could be coming into a lost decade. Like, first of all, cycle-wise, we're always, the world kind of goes in cycles, and it would make sense that the next cycle is about to happen. I really don't hope so, because it's probably not fun going through a lost decade now. I can't myself remember, because, last time it happened, I was too young to really understand what was going on. So I haven't been through a lost decade myself, actually experiencing something as an adult. But I can imagine it is tough. On the other hand, Warren Buffett actually made a lot of money during lost decades because he was focusing on individual businesses rather than the overall market, like investing in a highly diversified index fund, for example. So he actually did really well during some of the lost decades. So when you think about that, it's interesting. Now, I don't know if I would be as good as Buffett at picking those businesses that could actually power through a lost decade. How about you, Michelle? What do you think?
Yeah, I don't think I've ever lived through one either. I mean, I'm trying to think back when there could have been one. And if we look at some of the last times that we've seen stock markets breaking down, I mean, we've seen a few of the breakdowns in some recent years, in the last 25 years, with the dot-com bubble. There were some recessions that happened in the last 25 years, but none of them have turned into what would be considered a lost decade. Like in 2000, we saw the economy go into a recession and the stock market bust from the dot-com bubble. And in 2007, that's only 7 years later. So it's not really a lost decade, but in 2007 was the start of the great financial crisis and the housing bubble bursting, and the stock market went down for the subsequent few years. But I think starting in the early 2010s, the stock market recovered and went back up to newer highs toward the late 2010s. And maybe we could argue that the pandemic recession in 2020 could have been one if 2019 was the last time that the stock market was considered at a high, and then it had that temporary stock market crash and to fit with the short-lived COVID recession, but that didn't lead to a lost decade again. So every time in the last 25 years, the markets have recovered. But the last time I think that is a renowned, many lost decades happened after the Great Depression, where in 1929, the stock market crashed. And I think something like the S&P 500 didn't return to its previous level until something like 1954. So it took 25 years just to go back to that level. And I'm not saying we're going to necessarily have that happen, but historically there is precedence for not just one lost decade, but 2.5 lost decades. So that's it's pretty incredible if that could happen again. But there's a lot of warning signs that typically we should have markets go down when we see both valuations for the stock market and also other asset markets like in bonds, that they're all at classically high valuations that doesn't have much sustaining them, because the US economy is dependent on 70% consumer spending. And if people aren't buying as much, if people feel depressed from inflation and don't feel like they can afford as much, then they're not going to buy as many Lululemon pants or other disposable things that you don't really need. How many yoga pants do you really need? So the
Come on, stop. Many buy Lululemon pants.
like, but in all seriousness, the you know, most people are going to start pulling back. You're not going to buy an extra car. You're not going to buy an unnecessary thing if you're really feeling the crunch. And if you were to be laid off from your job, you're going to now be even more careful of how you spend your money. And then that's going to affect the bottom line of companies. So some people I follow, there's this person on Twitter named Jesse Felder, and he releases this newsletter, and I follow some of what he has shared in newsletters. And some of what we're supposed to expect is, apparently, if we think that there's going to be strong earnings growth with sharp rate cuts, that would be consistent with a 20% or more decline in reported profits and also a 30% drop in forward earnings. So what that means is rate cuts historically suggest the economy is not doing well. Like, you're cutting rates because having higher rates was just too high of a debt load. Like, people can't take on more debt at higher interest rates, like including companies. So if you're cutting rates, it's a sign that people are not able to sustain buying stuff, and therefore companies will not have higher earnings. So naturally, how can the stock market keep going up if their earnings are vanishing? So typically that's what people would base valuations on, is you think the company will generate more earnings in the future, therefore you think the company is more valuable, so more people buy it. But if people are just buying it and they don't know what the company is earning or not earning, then it's just leading to this point where another bubble could burst at some point. What do you think?
You said a lot of things I just want to touch upon here, Michelle. Like, first of all, also just for the listeners, we did talk a little bit about it, but a lost decade is usually a 10-year period where the stock market doesn't really move. So, it might move up, it might move down, of course, during those 10 years. But for example, from 2000 to about 2010, the stock market really did not move if you held stocks for that whole period in the S&P 500. And usually a bear market, which is defined by the stock market falling 20% from a previous high, usually a bear market, as far as data shows on the S&P 500, is between 9 months and 16 months. So bear markets are actually quite short compared to lost decades. And that's why lost decades are so interesting and scary. It's because it's over such a long period where you actually don't really see a return, and where you, especially if you invest like in the broader market, however, if you are more concentrated, you could potentially really, still benefit from investing. But as you said, Michelle, people aren't going to buy, honestly, like Lululemon pants. Now, I'm a big, of course, Lululemon fan, but what we've seen over the years is that those kind of brands that aren't too well known, people stop buying it. And then they choose the brands they know, and they would buy a little luxury item. A little luxury item for women could be a nail polish or a lipstick from Chanel, for example. They wouldn't necessarily buy the Chanel bag, but they would buy a little luxury item that would make them feel that even though times are tough and they don't maybe have a job or something like that, they can still buy a little bit of luxury. So it's companies like even Coca-Cola, even though you might think, oh, but how come that's luxury? It's, soda. But when times are tough, you might not actually go buy soda that often. or pop or whatever you want to call it in the United States. But then actually something like Coca-Cola all of a sudden was, oh, let's, we are having people over for dinner. Let's buy a little luxury item like Coca-Cola, which is a brand. So it's well-established brands. We also see in the toy category that parents tend to pick quality they know. So when they go to the movie theater, they want to pick a Disney movie because then they're certain that they're going to be entertained rather than just, let's go to the movies and pick whatever is on right now. They're going to wait until something they know is quality. So, during lost decades, it's interesting to look into some of those brands that can be considered little luxury items, which are, well-known brands that are considered to be luxury, but where you can also find it in a sort of price bracket where middle class could buy it, even though they're going through a rough time.
Yeah, and maybe that's part of what I was thinking, why I picked on Lululemon is, if you really need nice pants, there are some lower cost competitors out there that you might think like, oh, I don't want to spend that much on these pants, but I need them for my everyday life. It's part of my lifestyle. So maybe you'll go to Old Navy. Like, I'm not saying people should or shouldn't, but if you're really strapped for cash or you're just feeling a little more self-conscious about it, like it doesn't mean you couldn't afford the Lululemon, but if you have a competitor and it might not be the same, it might not be as luxurious, but if it gets the job done and you save $60, I mean, who cares? Like to me, I'm not so needing to show off brands I'm wearing. So to me, I don't see the appeal as much in a Lululemon. I've never owned it. If someone wants to prove me wrong and have me experience, what is amazing about it, let me know. But I currently, I would think like if you're a struggling consumer out there and you are thinking like, oh, I have the choice between buying groceries for my family or paying less for yoga pants, you're going to pay less for yoga pants and you're going to put more food on the table for your family is kind of how I see it if you're going through tough times right now.
100% agree on that. There are so many other options that you can go with rather than having necessarily to buy. And that's, there's a lot of brands in that kind of, they are sort of brands, but they're not a brand to the extent where they're what Buffett would call a consumer monopoly. So a consumer monopoly is like Apple and Coca-Cola, and where people, if they had a choice, they would 100%, if some people are like, if they're in a restaurant where they can't have a Coke product that is their favorite, they are not going to order soda per se, might just stick with water or order something else off the menu because they would not like to drink Pepsi or whichever brand was at that restaurant. So there are actually people that have preferences like that. And it's the same thing with, many, many brands out there where people seem to choose certain brands, and that's a consumer monopoly. It's a brand that's so strong that they have this competitive advantage that Warren Buffett also calls a moat. So a super strong brand. And those brands are many of them are going to do fine during a recession. But then there's, a whole lot of other brands that are just has not yet gotten to a level where consumers really feel so attached to it that I'm going to get this no matter what. I might not be able to get it as often as I used to do, but whenever there is something special, I'm going to buy that for myself. And there's a whole lot of brands in that category, and they are going to struggle if we're going to go into a lost decade for sure.
Yeah. And so wrapping up our topic of could we be in a lost decade or on the cusp of one? Maybe. Like there are actually a lot of stocks that peaked in 2021. And it's a great point you made earlier, Signe, of how from 2000, if you bought at the very top, like say you bought a bunch of Microsoft at the top of the market in 2000, you didn't break even until like 10 years later, like you said. It took that long. So that could be possibly what happens now if so many of us pile into Nvidia right now. Nvidia could be like the new Microsoft of 2000, and you could be buying at the tippy top. And you know what? You may not break even until 10 years later on some of these stocks. So let's just keep that in mind, like that we could already be experiencing that in some of our portfolios right this moment. And it's not to say it could happen to the whole market. It might not, but just be mentally prepared in case we are. This could be the very top of the stock market, and it's a slow moving unwinding. Like, it won't be obvious. We won't feel it if it's happening right now. It will only be like 6 to 12 months later that all the journalists and economists will be like, oh yeah, in hindsight, that totally was the beginning of the end. And, we see all these systemic problems and corporate debt being maxed out, and then companies starting to lay off people, and companies not being able to afford their debt. So they were declaring bankruptcy and wiping out the shareholders. So, you see all these things in retrospect, but you only see the pattern after a while emerge. Like, you might not see it so obvious unless it's a big name like that you don't expect to declare bankruptcy. And that was shocking. Then that could be one of the black swans to show like this is more than just happening to a storied company. It could be happening to many, and that could lead up to a black swan event of like an unexpected bad thing happening in the economy, and then it has a ripple effect throughout the stock market and economy. So I hope it won't come to that. Like, you would hope that between the powers that be, that they are managing economic policy right, like at the Fed, but the Fed can't control if we're going to go into a lost decade in the stock market or not. It doesn't matter exactly how much interest rates were up or down. If it's meant to be that the stock market has a lost decade, it would happen. But I don't know yet if company CEOs have just been buying back shares at too expensive of a stock price, and that it's just going to end up being a waste. Like, that could happen too, of like, oh, those CEOs were so dumb to, like, at the peak of valuations now in 2024, they're buying back shares and then their stock price is depressed for the next 10 years. Like, that could happen. Well, we could end up looking back in history and seeing that that was a bad move on some CEO's part.
It's really interesting what you also bring up here, Michelle, that, in hindsight, and that's how it most likely is going to be, right? It's going to be that, okay, in hindsight, we could see this. So if you're in a situation where you think, oh, yeah, I believe in the lost decade, what you should do is don't invest in companies with debt, high debt. Try to check if that companies have a minimum of long-term debt, not short-term, but long-term debt. And then also think about the consumer monopoly and the little luxury item. What are people buying no matter which economical climate we're going through? So definitely something to reflect on if you believe this is where we're going. So again, we don't know the future, and we can do all the speculation, but it's definitely, a very interesting topic, and also something that we as investors could think about. Michelle, do you have anything you want to end with?
Yeah, just because we're speculating about whether it could happen doesn't mean you stop investing. So you could hold some of your money at bay right now and follow some of what Signe suggested, is keep studying companies, find the good value companies that you can invest in that you think will continue to grow no matter what happens to the economy, whether there's a recession or not. And then hopefully you'll be okay. You just do the best decisions you can with the knowledge you have and keep working at it and keep tabs on your companies. Don't just think I can buy this now and forget about it. You still have to watch out what's happening to them. So if you do your homework and stay vigilant, you'll probably be okay.
That was so important what you just said, Tara. Love it. Thank you so much, Michelle. So we'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts, so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.